were used in basically in making of candlesticks. The important thing is also to notice that Steve Nissen presented Japanese candlestick to Western world. So Steve Nissen is the creator of those Western candlesticks, but the thing is he wasn't the first one who invented it. He is the first one actually who gave those candlesticks to Western world. Okay? Steve Nissen so presented Japanese candlestick to Western world. As we can see, he is very, very famous, and you probably have heard of Steve Nissen, and he is indeed very, very famous trader. So the thing is, we all need to know who basically invented the candlestick, because these are not Western creations. Japanese candlesticks are Japanese creations, and Western world just accepted it. So Western world is not creator of Japanese candlesticks. Westerns usually use the bars, not candlestick patterns. So this is the thing which we need to pay attention to. Similar to Japanese candlesticks, we call it Heiken-Ashi, very similar to Japanese candlesticks, but they use a slightly modified formula. In Japanese, Heiken means average, and Ashi, it means pace. So Heiken-Ashi represents the average pace of prices. These candlestick patterns can be used to identify trending periods, potential reversal patterns, points, and classic technical analysis patterns. The technique in Heiken-Ashi charting is pretty much different than using traditional candlesticks. Heiken-Ashi modifies the traditional Japanese candlestick by sending the open and close through a calculation of the average. So that is the main information about Heiken-Ashi candlestick. Now, these are some important candlestick patterns. We all know which they are, but we won't talk about it today because we need to concentrate on other things. This is the example of Heiken-Ashi candlestick patterns, and on the right side is Heiken-Ashi smoothed candlestick patterns. So we have Japanese candlesticks, we have Heiken-Ashi candlesticks, and all of those things help traders in decision making. The magic of candlestick pattern is basically it has 9 important points. And I can say 10 could be entry points, but today above all, I can say that entries are not particularly made by candlestick patterns, but candlestick patterns can give us also cues for entry points. Because as you can see, market has been very volatile, and sometimes when market is volatile, decisions cannot be made on candlestick patterns. So it's always about finding those confluence points. So candlestick, according to what I think of, candlestick have 10 very important points which we can call the magic of candlesticks. They create a confluence point. They signal momentum and can give us momentum trades. We can find historical buyers and sellers by using candlestick patterns. We also can use reversal points with candlestick patterns. Also swing highs and lows. Then accurate Fibonacci levels. Then imminent support and resistance levels, which we called master candle. Then we can ride a trend with it, with Heiken-Ashi. We can use it for the divergence, and as I said, a possible entry point. So these are 9 most important points for using candlestick patterns. This is the first picture, and I will present you all the examples. So this was basically the counter trend setup for today for GBP dollar, but the thing is, as you can see, why I'm showing you this is because you can use those important trend lines with candlesticks. Without those candlesticks, we cannot print trend lines. It's very, very important. So in addition to all other things, we cannot just put the trend lines so closely and so accurately without candlestick patterns. So candlestick patterns really do help us in the decision making concerning, especially concerning concerning trend lines close to support or resistance levels. So candlestick patterns can appear on each time frame, and they do appear on each time frame, but the significance of those candlesticks is not the same for each time frame. 1 hour candlestick patterns have significant, are very significant in day trading, but they're not so significant in trading higher time frames, just because higher time frames are more prone to important news events. Then this is the example of confluence. As we all know, candlestick patterns do create a confluence. Just let me pause the screen. And we can see in this example that candlestick patterns create confluence. If you remember this example, this is the example of candlestick pattern confluence, and this was the example of Bollinger-Bannon candlestick, where we use those wicks above and in Bollinger Bands to create entry points. So this is the example of using candlestick pattern with a confluence of an indicator such as Bollinger Bands. So the thing is, candlestick patterns significantly create confluence around important support resistance levels, especially if they are close to support or resistance zones. Bollinger Bands is the indicator which is used for decision making, but also is used for giving us the trend strength and dynamic support and resistance levels. So this is the example how candlestick patterns do create a confluence. Now this is the other example which I was talking about, and this you can see in this example that weekly resistance, weekly pivot points, monthly resistance, and daily pivot points can create significant confluence with candlestick patterns. Now this is not the example of just candlesticks, but those important pivot points for day trading and how those candlesticks react to day trading. So in these examples we can see perfect confluence points which go side by side with candlestick patterns, giving us much better choices for placing our stops and our target zones. So also candlestick patterns can appear in this way, and we know this indicator which gives you 48, I think, candlestick patterns. So all of those are very significant when they're close to their support and or resistance levels. So they're very, very significant. Then we can see also in this example how confluence is created with manually drawn levels and with Fibonacci, of course. So these red levels are manually drawn levels, and we can see here in this particular example how Fibonacci can also create confluence with our manually drawn levels. Also, it's important to notice that in this example we can see another candlestick confluence with important support. Now this is the example of Fibonacci because it's most obvious thing that without Fibonacci we just cannot, without candlestick patterns we cannot draw Fibonacci levels. That is very important point because if we would place Fibonacci on other chart, let's say chart patterns such as bar charts or range bar charts or line. I never saw that happening, but that would be pretty much inaccurate. The biggest point in Fibonacci trading is those wicks. That is what I'm always saying and always implying to, that Fibonacci just cannot go with without important candlestick patterns and important wicks. So this is the lowest part, this is the highest part. Now observe this candlestick. This candlestick is basically momentum candlestick. So one of those reasons which I'm mentioning today is that basically this is momentum candlestick trading. And now again we use now Fibonacci for candlesticks, for momentum, and again for important support and resistance levels. So in this example we can see momentum candles, one to the buy side, one to the downside. And again, without the candlestick we cannot use momentum properly. We can use MACD, but MACD cannot tell us where to enter or where to exit based on candlestick patterns. So actually we need to use momentum for measuring the actual entry and actual potential target. So this is momentum candle, this is also momentum candle, and without those important wicks we just cannot take any trades based on momentum. So this is the example of momentum along with Fibonacci point. Now also one of reasons why we use candlestick pattern is basically, and candlestick generally, is divergence. In this example we can see a nice divergence forming, but again what is the conclusion? Without candlesticks we just cannot spot that divergence as it should be. We need valley to appear. So in this example we see valley here and valley there. So this is regular bullish divergence. Without those wicks, again, that is why I'm always implying how those wicks are important. Without those wicks we just cannot trade those candlesticks as we would be trading, or chart patterns, or divergence, or momentum, or Fibonacci. Now this is the summary of all important points. That is why we call it the magic of candlesticks, to see why those candlestick patterns do help us in our day trading. So again, divergence. When divergence appears, you know what you should do. Either you take a position if it's hidden divergence, trend position, or you get out of position if it's in contra of your trade. So when we see wicks, we just connect it. We see wicks also on histograms, then we connect those lower parts, and we get divergence. Again, this is the important point to notice, because we have also divergence coupled with trend lines. So here we see a trend line, 1, 2, almost 3 touches, and then again we see divergence. When candlestick pattern breaks, retests this trend line and proceeds further, we can talk about breakout, pullback, continuation pattern. So candlesticks also give us a potential to trade those breakouts based on current momentum and prior strength. So this was prior strength, now divergence appeared, and current momentum is to the upside. So breakout, pullback, continuation, trade. Without candlestick patterns it's much harder to spot proper breakout, pullback, continuation pattern. Also the important, this is a slide which we already saw, but this, yeah, I can use this slide, because with candlestick patterns, this is the thing I forgot to mention on the first slide, we can use also projected trend lines. So when we see a proper trend line, we can see 2 touches. So this is first touch, This is second touch. Now, we can also try to think in the future. So, when we see projected trend line, we are guessing that price might come to this level and then we can sell it. Well, the price came something in between this level and this level. Actually, it came today just at 62.26. Came here, the price came here. I don't know how many of you traded this, but it came here and then it was rejected. If you remember the analysis from today, this is today's example, the price came here to this zone exactly at 62.26 and target was hit. Actually, I was aiming for 62.35, but it doesn't matter. The important thing to notice is how we can project the trend line. And I did that in today's analysis. I made a trend line projection. So this was trend line which connected two peaks. You can see the first peak here, first peak there. And then I'll use my logic, which was basically telling me now there is a potential chance that prices will go down from that point. So most obvious, now pay attention to this slide, most obvious for 90% of the traders would probably be that they shorted here. And yeah, you would be right if you shorted there. This was 62, let's say 62.10. And if you shorted into 62.10, you would still be in a profit. But the logic with those candlesticks is wicks, especially wicks, is we can move the trend line to project it. So I placed this trend line and I artificially moved it with this dotted trend line because I presume that if next candlestick goes above this trend line, it will come to this point and then sell off. And basically it happened that the price was sold off here straight to pivot and probable long point for GBP dollar. So that was most obvious what happened today. We had some selling going on, but again I'm implying for the power of candlestick wicks. You know that candlestick wicks are pretty much important, and when we do connect those patterns, such as this example, we can also make projected trend lines. Me and Chris will make a webinar, and we have a webinar soon about trend lines, so I will be also explaining how to actually make projected trend line. But the thing is, you cannot make projected trend line without those wicks. So wicks are very important. Now these are also historical buyers and sellers. These are historical buyers and sellers. You can see in this region historical buying. You can see in this region historical selling. Now if you move this rectangle to this side, you can see that again this was sold off based on historical sellers. This is historical buying. Now if you move this rectangle to this point, you can see again that historical buying also took place here. This is selling, then now momentum selling, now momentum selling, now momentum selling. So basically all these things which we are actually do today with our trades are done, as you can see, with our with candlestick patterns. It's just impossible to learn everything by just watching the charts and observing without doing anything. So the most important thing is to use all the things which are at your disposal to basically get you a good entry point. Historical buyers and sellers are very important in my trading way, the way how I trade, and they do have special place within my trading rules. So having a good history of sellers and buyers will always help us to determine next possible entry point. So history of buying and selling is much important. Now also with the Fibonacci confluence we come to double Fibonacci confluence. So with candlestick patterns we can use double Fibonacci confluence from bottom to top, from top to bottom, from bottom to top, and so on. So now we have double Fibonacci confluence. Double Fibonacci confluence is also used in day trading because when we see double Fibonacci levels, then we can usually base our decisions much easier with double Fibonacci levels than with single Fibonacci levels. But sometimes those double Fibonacci levels are, I can say, they are not so important if we have other parts of confluence, such as historical buyers and sellers, projected trend lines in general. Also, the last thing which I want to say before I hand over presentation to Chris, this is how we use master candles. Master candles are again one of those candlestick magic things. Master candles help us to define basically all important support and resistance points. So this is the master candle bottom, this is master candle top. We have basically two candles here, but we can say that those candlestick wicks, we call it master candle, imply important support and resistance levels. Now we can also use, we could use before this candle, after this candle appeared, we can also use this candle only, but more significantly is if we have also this candle low. So we can neglect also this candle, but we can see that those candles are side by side. So the important thing to know is that if this is if this is a master candle top, this is master candle bottom. But you can see also that this bottom is very significant, because after it was broken, this candlestick broke through it and retested it. So again, master candle is called if we have one single big candle which is holding other candles within itself. So it's called a master candle. If we have two side-by-side candles which are pretty much big with those wicks, then we use those two wicks for one master candle. So effectively this can be called as master candle. So again, I will be showing you the slide with the candlesticks, why those candlesticks are important, and Chris will show you his way of seeing those candles. But guys, I always remind you that all of these points, when you combine those, you will get much efficient entries and exits. So all of these points should be taken into consideration when trading those important candlestick patterns and confluence of all of those things which go with candlestick patterns. Now Chris can continue with his part of presentation. Now the point of this webinar is to kill the prejudice which happens with candlesticks, that candlesticks are only used for buying, selling, and for placing entries. So all of these things basically come from those candlestick patterns, and all of these things are equally important when you do day trading. And I intentionally say equally important, because one cannot go without another. Everything is in confluence with the candlestick patterns. So Chris, you can continue. Guys, I hope you enjoyed in this little presentation of mine. So basically now I will hand over a presentation to Chris. He will share his view. So I think Chris is ready to proceed.
Yep, I think that the mic is now good to go. Do you hear me?
Everything is okay.
1, 2, 3. Do you hear me? Yeah, good. Okay. So good stuff there from Nenad. We're going to continue with, indeed, with the candlesticks. They are great tools, not only indeed for entries and exits. I mean, there's a total massive list, and then it had, and they're very useful. I think also for specifically Confluence, they're a great tool. And I love Confluence. As you know, I try to find Confluence. Of course, as I said in the live webinar, our critical thinking cap always tries to find supporting evidence for trade or analysis that we think is interesting. So we have to be careful, of course, that we not only find Confluence, because it's sometimes easy, our brain picks it up easy. We have to stay critical. We have to find the balance between finding Confluence and staying critical towards the charts and our bias. But if we have a good trading plan, a sturdy trading plan, then we should be able to find that balance. So what I wanted to share with you was basically the fact that, in my opinion, the Forex market is all about trends, patterns, and support and resistance. I call it the triangle, or the golden triangle, whatever you want to call it. I think the market is basically, the heart of the market is these three things, right? If you look at why the market does what it does, well, not why, but the outcome of what the market does, the outcome in sense of price movement, you see trends occur, you see support and resistance, and then you see those patterns that occur at support and resistances, right? So these are the three things I think that are very key when Forex trading. So what I like about chart patterns and candlestick patterns, obviously, is the fact they're very important patterns. So we're going to be focusing on that second part today. Regarding the trends, obviously, you have the patterns occur more often in ranges, but certainly can happen in trending modes as well. And let's see, that's about it. Alrighty. So we have a lot of patterns in general in the market, not only chart and candlestick, as you most likely know, fractal patterns, wave patterns, Fibonacci patterns. We have break patterns, bounce patterns, break and pullback patterns. I mean, there are literally uncountable number of patterns. The advantage of combining them is finding more confluence and basically finding the confluence levels at certain confirmation spots. For instance, when we're looking at candlestick patterns, engulfing twins, shooting stars, and pin bars, within chart patterns like flags, wedges, and reversals, I think as a trader you already have a very interesting framework to look at. You already have very good, solid points in a potential trading plan that isn't finished yet, but certainly is very well structured, I think, and just looks at the core of why price or how price moves. And I think you already are doing a great job, because at the end of the day, you're getting confirmation of the chart pattern. A chart pattern is something that we normally see visibly pretty well, but where does the chart pattern stop? Where does the chart pattern continue? The candlestick patterns could give that extra guidance and extra confirmation. So I think that they are a great combination here. They give more confluence, and these patterns basically reinforce each other, I think, very good. These chart patterns have clear lines in the sand. They are excellent support and resistance levels, basically, and as I said, the candlestick patterns confirm whether price is indeed respecting or breaking that pattern. So that's the great thing. And with candlestick patterns in mind, we could look at bounce and breaks of those chart patterns, because basically chart patterns do provide a lot of good opportunities, either for trading the chart pattern itself or waiting for the break of that pattern. So let's take a look at some examples on the chart now. We've talked enough. Let me scoot over. The euro dollar, for instance, recently had a ton of good examples, I think. This is just a week ago. I thought it was a cool example where you just see two triangles and one flag, the two triangles on the left and the flag on the right. And it's a great way to spot the end of these patterns. Now, obviously, if you're trading triangles, a doji right here, where I have the green dot at the bottom of the triangle, does provide some pips to the upside, but you can see it doesn't go all too far. So incorporating the direction of the trend, which is obviously down if you look at the moving averages, would help us orient ourselves maybe on taking shorts at the top of the triangle instead of trying to take the bounce off the bottom of the triangle, and hence more profitability to the downside than a small bounce to the upside. Actually, if we take the bounce at the top of that triangle and hold for the break, you get an extra bonus pips here. Same for all of these patterns, in fact, where price indeed continues through with the downtrend after making these pauses. So what trades would be the best? Well, bounces at the top of this triangle, for instance, are pretty interesting, right? Now we have dojis, we have shooting stars. Those are all potential signals that one might want to consider. Here too we have wicks. Now the problem with a flag is that the fact that the price rises in a channel, so even if a trader takes this shooting star or this one, you know, the first two, in fact, we do get a higher high. That's one of the disadvantages of a flag, and one of the advantages of waiting for the break of the flag and not taking the top of the flag. Although the top of the flag could be brilliant, you always have the risk that the top of the flag will be extended, or expanded I should say, with these two hits, for instance, and hence, and therefore, the previous bounce wasn't leading to the break that you do hope here later on, where it eventually did happen. So there's a slight difference. That's why contracting triangles, I think, provide even more, let's say, are less risky, or in a way that the top of the triangle doesn't get broken. The top of the stop loss doesn't get endangered as much. Let me say it this way. One of the ways to combat that with the flag is either putting a looser stop loss, a stop loss that is above the previous top, like this, for instance, would save the trade against the fact that price is going with higher highs, and not putting it ultra tight right above the current wick. That's one way of doing it. The other way of doing it is trying to take a short there with a tight stop loss or a loose stop loss, but then trying, if price doesn't break the trend line, exiting at break even, for instance. It would be another way. But I think probably it's easier to tackle it with a looser stop loss on average. Exiting when the trade is not going in the direction of a trader is quite, well, it's not the easiest. The other way, of course, to trade the bear flag specifically, or bull flag, is the break of it. Were we looking for price action signals that we're breaking? Do we have that? Let's take a look. That's also valid for contracting triangles, but a candle like this is a break. A candle like this is a break. Good breaks because the candle close is near the low, candle close is near the low. Very important. Do we have that here too? I'm zooming in a lot here. And probably this candle would be okay. This is a bit small for the flag break here, this one. Let me zoom out a bit again. Right here. That looks like a good. It's also a candle that's fully below the moving averages, so that looks good. All right, so let me zoom back out. So that's what I mean with candlestick patterns or chart patterns. That's what I'm looking for as either a method of entering or as extra confidence to trade it. It depends from case to case and from structure to structure. As I said, this is not a full-fledged trading plan as yet, but I do think that these components are solid pieces of a trading plan. Here's an example of kind of it's an ascending wedge, in fact, but momentum is down. The downtrend is definitely in play after the break of this trend line. This trend line here. for instance. So I don't think that this is, I think this is more a bearish ascending wedge. So if we see, for instance, and let me zoom in now, this may be because it's not confirmed, but for instance here, this doji shooting star at that trend line within the downtrend would be an example of a candlestick at a top of an ascending wedge with downtrend, by the way. And although this could be maybe considered to be at start, maybe even a bull flag, potentially, like this or something like that, right? If someone were to have traded, for instance, this candlestick right here, because it could have been seen like a rejection pin bar at maybe a top of, although it's not a confirmed resistance line, if you take something like that, it would certainly have been a loss if you use a tight stop loss, but not if you use a wider stop loss, by the way. Or if you traded this, if you traded against the trend and took this pin bar off the bottom, some profit, but not as much as trading with that momentum here. So obviously this is not a perfect science. This is going to, all traders are going to bump into moments where market meets our criteria and the things we look for, but still doesn't do what we want it to do, of course. And let me give you some examples of that, how we can handle that. Maybe some examples where it doesn't work as nicely as we've seen so far. Let's try to find a few. 1 second. Still on this euro dollar. Still recent price action. We've, of course, sorry about that. We had, of course, this bear flag, a very big bear flag. I don't know if you remember, mid-September here. Got a good resistance line, support line, price bouncing off, up and down here. We could even draw maybe a line like this as an extra support line. Already. Are there any false signals here that we could interpret differently, maybe? Let's see. Don't see any, but you can see that within a downtrend, basically trading the bottom of a flag is possible for the corrective bounce, but you're not going to get a very massive profit potential. You're going to, at max, see the price move up to the top of the flag in most cases. Of course, unless there are rare occasions, well, not rare, but occasional occasions where price does break the flag to the upside, and all of a sudden we see an acceleration like that. But usually speaking, the flag continues with the trend, or in many cases at least, and trying to catch the top of that flag is more successful. There are a lot of flags on this euro dollar. In fact, let's see. Here's a trend line. This is a rectangle, in fact, isn't it? Like that. Didn't get much follow through though. Another example of a bear flag here. Yeah, just be careful with the tight stop losses, that's all. I'm trying to find an example where, you know, things are not as perfect, but I'm not seeing them at the moment. If you do see one, let me know. But let's see, maybe this one here. Well, if you're trading something like this, for instance, let's see, contracting triangle, what I think, obviously, one of the things that could happen is that price moves away from the triangle, moves away from a chart pattern before you have a chance to see the confirmation of a candlestick pattern. That's one of the problems that could arise. So in that regard, let me move on. I don't want to get stuck here too long on this particular part. Problems that could occur when tackling the market with this. As I said, unclear candlestick pattern. For instance, is it a shooting star? Is it an engulfing twin? It's you know, the market is sometimes on an hourly chart, 50-minute chart. We don't see patterns may be perfectly, and they could be maybe just a bit of a grayish, doubtful area sometimes. That's just the fact of the matter. Market is nice, but sometimes certainly not perfect, so that those things can happen. Sometimes we can see an early candlestick pattern in a chart pattern. Sometimes we could, for instance, if we have a contracting wedge, we have a downside up. Let me just draw it like this. And we see a candlestick pattern at the red circle. But then what price does is move down and then up again. And we see an expansion of that wedge just a bit higher. So you get the candlestick pattern, in retrospect, halfway, right? And at that time, we have a steeper line like this. So it looks like a candlestick pattern. These things you got to be careful of. Draw multiple trend lines. Think a bit out of the box. Don't be maybe too rigorously believing in this is the only, this must happen. Nothing must happen. The market is very flexible. And most cases we see, certain things when we're out of the trade easier because we let go of the bias that we had and the confirmation that we're always looking for it. So that's what you want to be careful of. You want to kind of like be careful of mirages, false things that seem like goody good, but vanish into thin air in a way when we're out of the trade or with a loss or whatever. So you want to be careful with early, I'd say early candlestick patterns. Careful with unclear candlestick patterns. So that's one thing I wanted to warn for. Other things, taking profits, whether you go for a small hit or you go for a bigger hit. Let's say you position yourself at the top of this this contracting triangle like that. Do you aim for the triangle bottom or do you aim for the break? It's not a problem. It's something to think about. Let me say it this way. A mixture could be good. It depends. What I, as a rule, use, if you got several hits, like 3-4 hits on the top of a flag, I would let it run. If you have the second hit or the fifth hit, I would tend to do at least a mixture, because then either at the second hit the market is still vulnerable to a bigger flag. At the fifth hit on the top, in a bear flag, that is, the fifth hit on the top of, for the bull flag then, that is, no, on the bottom, excuse me, then you might actually be looking at a channel in the meantime to the upside. And then the likelihood of a break could be diminishing too. 3 to 4 usually is optimal. And of course, last but not least, if the pattern is too small to trade, if the size literally of that pattern is, well, a great example was, for instance, at the very beginning, our first thing where we looked at the euro dollar, wasn't it? Way here. These triangles, you don't want to trade them to the upside. There's no pips to be made here, right? Because unless you really are happy with, well, it's even not that bad, 20, but anyhow, you have the perfect entry and perfect exit. The span is 20, so it's not that luxurious. Obviously, a flag like this does have decent space, because if you take it off of this wick here and you take it roughly to closer to the edge of that top of that flag, you're close to 50 pips, which is a different ball game. So these patterns, you're going to see them everywhere. There are a ton of patterns, ton of trend lines. Actually, as Manette said, we're going to have a trend line webinar to help you with trend lines, because trend lines are very important for spotting and putting trend lines onto to CD patterns. So that's very important. You can draw trend lines, a lot of them, and you'll see, the pattern's a lot easier like that. This is a typical bull flag, bear flag, roughly. And this is maybe not an easy one, because You got the top line here, for instance, and the price misses that top line, and you get a big wick here, right? A pin bar. One of the things where I wouldn't necessarily want price to touch the top of the flag in this case, does anyone know by any chance? What is the reason why we don't necessarily want price to get all the way to the top in this case? Take a look at this particular situation. Does anyone know the answer? I'll give you a minute here. So if you look at this scenario, it's a classical downtrend, right? We know that the euro-dollar has been a downtrend for long. This is end of July. At that time, it was in a downtrend too. We had a recent, all we know here at the moment is the fact that price made an impulse and is in a downtrend. We know that. Price is below the EMAs. EMAs are down. Slow, corrective move to the upside. Bear flag pattern. And the question is, price misses, this wick misses this top of the flag by about 5 pips. It's anyhow, it's not much, but for a flag like this, it is. What kind of things could you think about? Got one answer, great job. I'll give the feedback in a second. Anyone else? It's not an easy one. There are actually multiple answers, so that one could think of, but they're not easy, I think. I don't know, maybe I'm wrong. Let's see, I'll just give you a few seconds. Made a high. Made a high. I'm thinking what you mean, MJ. Made a high. Not entirely sure. But I'm not 100% sure. Let me know maybe in more detail. But okay, here are the answers. One thing is the fact that price broke below that bear flag. So this is a first break. All this could be is a stronger pullback before we get the second break. I don't know if you have heard about the rule that the second break is better than the first break. This is a case where that is so. Hesitant break, strong pullback, big break, second break. Because we did have this initial break, I wouldn't expect price necessarily to go back all the way to the top of the flag, especially if I see a candlestick like this. That tells me that the break sequence, the BPC pattern, yet again a pattern, is on. It's here. It's starting. So in that case, no need to wait for the top. That's the first thing. The break, although small, is a break. Could be a false break. We don't know that. But with a pin bar like that, the odds are back in our favor. Audrey said the MA is near. Yeah, definitely. MA, price is basically respecting the top of this 21 EMA band. So when the EMA band is far away from the top of the flag. Good point. Excellent. Let's see. Draw a line at the tops. Price made a high. Yes, if you draw a trend line like this, good point. Indeed, this is a resistance line as well as a third touch off of that trend line. So the angle of the flag is shifting. Good point. So these are all valid arguments for not expecting price to get there necessarily. Let me think if there was one more. Not that I know of. We made a lower low here, but that's kind of like the same as the break. I don't think so at the moment. Let's see, horizontal. There's a horizontal level there too, indeed. I think that's about it. maybe a fib, maybe, if we put a fib on, normally the flag goes to the 38.2 fib, so the fact that the 38.2 fib there and a triple top are holding it shouldn't surprise us either. So that may be a fourth reason as well. So let me zoom out again. So I guess we're running towards the end of the session anyhow. Are there any questions you might have? Here's an example of a stronger, it's not even a flag anymore because it's such a strong upside. One of those cases where this wick looks great, but look, you get downside and boom, still one more strong upside. Well, an example where we had 1, 2, 3, 4, 5, 6 hits. So getting already a bit questionable. As I said, third, fourth are optimal. After that, could be a channel, and look at that. So if you take that wisdom into account, then if anyone trades these wicks, partly taking profit at the bottom could be in a scenario to do, a thing to think about. If one is really putting the stop loss all the way up here, which is the swing high that one can think of, or even higher maybe, then this pullback would still be survivable, by the way. But this is one of those cases where price, the flag is not that perfect, in fact, far from it. Later on we do get the break. Kind of a messy break, but okay. Well, folks, that I guess wraps it up. Thanks for being here. Let's see, next week we have more webinars. Monday, Tarantula is going to take a look at his weekly FX recap on Monday. Wednesday is his normal expert advice, I think it's called, right? Then join me Tuesday, Wednesday, Thursday morning for the live trading lab. Today I was looking at, I forgot what I was looking at, dollar yen. That didn't do too bad. I had a pending order here. We got about 35 pips, but I was actually aiming for 70, so it wasn't enough, and I exited for break even. Because here I exited here because it looked like, to me, it looked like the fact that this was, the price was, let me tell you why, just quickly. I like the short here, but as price moved against it, that's fine. I had the stop loss just above it. I moved the stop loss lower, obviously, and then I want to price to continue down. But as it hesitated here at the moving averages, I recognize that we were probably going to get a bigger correction, and the price was using the moving averages as a bouncing spot. So the dynamic had changed. So I got out for about +1. So I think there was nothing wrong with the entry, the exit. I was just aiming for a higher TP. So that, what can you do? As an example, I did take a short in here on the EJ. That's doing a bit better. Eurodollar, yeah, Eurodollar. I didn't want to trade today because there was too much resistance confluence at 137.80 when it was breaking this morning. When it was breaking H3, I said no way I'm going long because there's too much resistance. That proved they need to be true. I didn't short it here, but I didn't go long. Because of the fact that there was too much resistance. There's a big fall indeed after that. Yeah, if you're more of a reversal trader, it could have been worth thinking about because there was a lot of things that were in the zone to give confidence for a downside. But I like to trade with momentum, not trade turning spots. So that's why I didn't trade it, because it didn't fit. It doesn't fit in my plan really. But there was a lot of confluence there. So anyhow, those are things we discuss in the live trading lab. So please join us then. And otherwise, thanks for joining. Wish you all good trading. Wish you a good weekend. And see you all hopefully very soon. Cheers, everyone.